India's retail inflation has jumped up to 7% in August from 6.71% in July, mainly due to higher food prices. The consumer price index based inflation is above the Reserve Bank of India's comfort level of 6%. So in this session, we will see what is inflation, what is retail inflation, causes of inflation and types of inflation. So let's begin. Inflation is a rise in prices of goods and services which decline the purchasing power of households to buy over time. The drop in purchasing power can be seen in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Let's see what is retail inflation. When we talk about the rate of inflation, it often refers to the rate of inflation based upon the Consumer Price Index or CPI. The Consumer Price Index tracks the change in retail prices of goods and services which households purchase for their daily consumption. To measure inflation, we estimate how much CPI has increased in terms of percentage change over the same period the previous year. If prices have fallen, it is known as deflation. The central bank, that is RBI, pays very close attention at this figure in its role of maintaining price stability in the economy. The Consumer Price Index monitors retail prices at a certain level for a particular commodity, price movements of goods and services at rural, urban and all India levels. The change in the price index over a period of time is referred to as CPI-based inflation or retail inflation. Generally, CPI is used as a macroeconomic indicator of inflation as a tool by the central bank and government for inflation targeting and for inspecting price stability and as deflator in national accounts. CPI also helps understand the real value of salaries, wages and pensions, the purchasing power of the nation's currency and regulating rates. CPI, one of the most important statistics to ascertain economic health, is generally based on the weighted average of the prices of commodities. It basically gives an idea of the cost of the standard of living. Simply put, CPI specifically identifies periods of deflation or inflation for consumers in their day-to-day living expenses. If there is inflation, that means when goods and services cost more, the CPI will rise over a period of time. If the CPI drops, that means there is deflation or a steady reduction in the prices of goods and services. Now, while discussing CPI, let us have a brief look at the WPI, that means Wholesale Price Index. The Wholesale Price Index reflects changes in the average prices of goods at the wholesale level, that is, commodities sold in bulk and traded between business entities. There are certain limitations in using WPI as a measure for inflation, as WPI does not consider the price of services and it does not reflect the consumer price situation in the country. Wholesale Price Index WPI is released by the Economic Advisor in the Ministry of Commerce and Industry. The purpose of WPI is to inspect movement in prices of goods. They reflect supply and demand in industry, construction and manufacturing. The index basket of WPI categorizes commodities under three groups: primary articles, fuel and power, and manufactured products. WPI is extensively used for short-term policy interventions as it is the only index that is available on a weekly basis. Now, what is the causes of inflation? Simply, there is only one solid reason. An increase in the supply of money is a root of inflation, though this can play out through different mechanisms in the economy. When there is more money and there is less goods, so people will run with money in their hands after us very limited commodities, and this will increase the price of the commodity. In such a case, here when RBI jumps. Now, let's see the types of inflation. Inflation can be classified into three types. That is demand pull inflation, secondly cost push inflation, and the third is built-in inflation. Now let's have a very brief look. Demand pull inflation describes how demand for goods and services can drive up their prices. If something is in short supply, you can generally get people to pay more for it. Cost push inflation. Cost push inflation often kicks in when demand pull inflation is going strong. When raw materials cost increase for businesses, the businesses in turn must raise their prices regardless of demand. Built-in inflation. As demand pull inflation and cost push inflation occur, employees may start asking their employers for a raise in their wages. If employers don't keep their wages competitive, they could end up with a labor shortage. If a business raises workers' wages or salaries and tries to maintain profit margins by raising prices, that's built-in inflation. That's in today's session. See you soon.